This video is about mergers and acquisitions. I have included type of mergers and advantages of mergers and acquisitions. The primary goal of financial management is to maximize wealth, and growth is essential for growing the wealth of equity shareholders. Growth can be accomplished by expanding existing markets or entering new ones. Internal growth and external growth are terms used to describe how a corporation can expand, diversify its business internally or externally. Internal expansion requires that the company expand its operating facilities such as marketing, human resources, production, research, and information technology, which needs a significant investment. Internal growth requires not only a large sum of money, but also time. Thus, a company's expansion potential is constrained by a lack of financial resources or time. The business can overcome these two issues by purchasing outside production facilities and other resources through mergers and acquisitions. Mergers and acquisitions are the most popular means of corporate restructuring or business combinations in comparison to amalgamation, takeovers, spin-offs, leverage buyouts, buyback of shares, capital recognition, sale of business units and assets, etc. Changes in ownership, businesses mix, asset mix, and partnership with a goal of boosting shareholders' value are referred to as corporate restructuring. To maximize wealth, an organization must regularly assess its business portfolio, capital mix, ownership structure, and asset allocation to identify possibilities to boost shareholders' wealth. There is a lot of confusion and controversy about the exact meaning of phrases related to corporate combinations such as mergers, acquisitions, takeovers, amalgamations, and consolidations. Although the economic reasons for motives and effects of corporate mergers are similar, corporate mergers and amalgamations are governed by the Companies Act, whereas acquisitions and takeovers are governed by the Security and Exchange Board of India, SEBI, and stock exchanges listing agreements. Mergers may be classified into three types: horizontal, vertical, and conglomerate. Horizontal merger. When two or more corporate firms that operate in related industries come together, it is called a horizontal merger. Consider the merging of two publishing companies or two packaging manufacturing businesses. These mergers are frequently stated as being motivated by the elimination or reduction of competition, the end of price cutting, economics of scale in productions, research and development, marketing, and management. Vertical merger. A vertical merger is a combination of two or more companies that are active in distinct phases of manufacturing or distribution. For example, the merger of a spinning and weaving enterprises. Vertical mergers can be either progressive or backward. When an organization merges with a material supplier, it is known as a backward merger, and when it merges with a customer, it is known as forward merger. The key benefits of such mergers are cheaper material purchasing prices, lower distribution cost, guaranteed supplies and markets, lowering or stabilizing obstacles to entry for competitors, and so on. Conglomerate merger. A conglomerate merger occurs when a company from one industry merges with a company from another. Mergers of different industries such as the manufacturing of cement products, fertilizer products, electronic products, insurance, investments, and advertising agencies are common examples. Let us talk about the major advantages of mergers and acquisitions. The major goal of mergers is to get an operating cost advantage through economics of scale. These economics emerge as a result of increased utilization of manufacturing capacity, distribution networks, engineering services, research and development facilities, data processing systems, and so on. In the case of horizontal mergers, economies of scale are the most important. The primary sources of benefits in vertical merger are enhanced activity coordination and decreased inventory levels. It results from complementary activities. For example, one firm may have financial resources while the other has attractive investment opportunities. Similarly, one company may have excellent research and development capabilities. In all of these circumstances, the merged concern will be more effective than the individual firms. The combined worth of merging enterprises is likely to be greater than the sum of the individual entities. If a company decides to enter or expand in a specific area by acquiring a firm in that market rather than relying on internal expansions, it may offer various strategic advantages. It can prevent a competitor from establishing a similar position in that businesses. It provides specific timing benefits, and it may involve less risks and even less cost. Under some scenarios, tax benefits may be the motivation behind a merger. Assume that when a company with accumulated losses and unused depreciation merges with a profitable company, tax benefits are better utilized because its accumulated losses, unabsorbed depreciation can be balanced against the profit-making firm's profits. A company in a mature industry may make a lot of money, but it may not have many prospects for successful investments. In such cases, a merger with another firm involving monetary compensation is often a more efficient use of surplus funds. Another significant advantage, particularly in conglomerate mergers, is diversification. The merging of two unrelated enterprises would tend to reduce business risks, lowering the cost of capital of the firm's earnings and increasing the firm's market value. Thanks.